Good morning, good afternoon. Welcome to Develop Your Edge with Anthony Crudele. I'll be your co-host, Tom Schneider, CMT with NinjaTrader. Before we bring Anthony on, I do want to remind everybody that futures and options trading contains substantial risk. Not for every trader. You could potentially lose all or even more than all of your initial investment. That's why we recommend you use risk capital. What is risk capital? It's money that you can afford to lose, doesn't keep you up at night, doesn't extend your retirement horizon. Also, want to remind everybody that past performance is not necessarily indicative of future results. And what we talk about here in this show is uh, contains neither trade recommendations nor financial advice, therefore, should only be taken for educational purposes. And with that, I would like to welcome back Anthony Crudele. How are you doing, Anthony?
Good, Tom. How are you? Last show of the year, man.
Yeah. Time goes by fast, but yeah, we're doing okay out here. We're probably like you experiencing maybe a little bit of a cold front coming in. Seems very
Yeah,
cold here.
it's a whopping 72 degrees this morning here in South Florida. It's
Better
terrible.
get your sweater out.
Oh man.
So lots
So
happened this week. I know you've probably been very busy. And the topic of today's show, it's pretty much the main event this week was FOMC meeting. Um, that was yesterday, 2 o'clock, but I think also 2:30 was very important and on. Now, what's your take on this?
so yeah, today I want to talk about some tips. I kind of don't like that word, but it's kind of it fits in with what we're talking about today. Tips for trading FOMC and CPI. As we know, data points this year are extremely important because we're all focused on what the Fed is going to do at rates, right? So we're always looking at CPI, and there's people coming out of the woodworks that don't even know what CPI is and talking about CPI on Twitter, right? So it's one of those things where you're getting a lot of retail traders coming in and trading these types of days. And obviously FOMC days, which has always been really a busy day. I mean, you can go back and look for many, many years. I actually put a tweet out the other day and said that FOMC were actually the most sought after day when we were in the pit to trade. And then now I almost barely trade them. And I want to talk about my approach to trading them because I think that too many people are coming in and seeing the action, the bright lights, right? The flickering, and it seems like there's opportunity when in reality, the opportunity comes a few days later. And the opportunity is not to trade these numbers. I mean, these machines that are coming in, reading the data, and they're going to come in and you see these S&P and NASDAQ moves. I mean, the S&P is moving 100 points, in a matter of minutes. And that is just not typical action, as we all know. And that for me, as an experienced trader, I still look at that and say, it's really untradeable. I mean, because I can't click into a 100-point rally or a 100-point break. I don't want to be the one who's stepping in front of it and getting, run over. And it's almost impossible to buy into it because you have no way of managing risk because you just don't know where it'll stop. And it could go up 100 points on a bar, but it could have it 5 different times. It breaks 25 handles in between that 100-point break. So there's just too much going on for us to be able to trade that action. And so I look at a lot of things as the rule of 3. I get into all my positions a third. Not always, but most of the time I do. I look at every single data point and I always say there's typically a 3-point move. You have the initial move and then you have a move following it. That's a lot of times it'll be a mean reversion move. And then potentially you have that third move, which continues that trend, or it's a pause and then a complete mean reversion, right? And it goes back down and takes out a low or a high. So most of these moves, because they move so fast on the onset, that initial move is, you don't know that that's the direction until 2 moves later. So I always look at that as my first tip, right? Is that the first move is not necessarily the move that is going to, tell us what the market's going to do. And it's really because, and I credit my one friend for this. He was a prop trader for a great group, and he's just probably one of the best data news traders I've ever met. And he told me, he goes, Anthony, one of my skills is identifying stupid news. And he uses that in kind of like a funny term, right? In the sense of like, okay, are the algos and the machines and the day traders way overreacting to this current news that we have here, right? Is this news is the market stupid for acting this way? Because most people will, a lot of people will say, oh, the computers are so efficient that they just take us right to where the pricing should be. And in reality, I don't believe that, right? I believe that there is a lot of inefficiencies there, and we use the algos to give us prices that we never thought we'd get, because it becomes, they're chasing prices. And especially rallies this year, which I kind of quickly want to touch on, and why I think the rallies are so vicious. Not necessarily always because people will say that rallies in bull markets are always going to be the fiercest. That is always going to be the truth, because you have squeezes for those that are short and you got people chasing. But there's a lot of bad habits that were developed over the last several years because of zero interest rates, because of the government pumping money into the system. And you just have people just buying dips, and nobody wants to miss the dip. So that has become such an ingrained bad habit in people, that you have people that are always chasing rallies, which give you these far extended moves, which fits more into why I say that there's always a 3-point move here, and it's a 3-day thing. So let's take every single data point, right? CPI, massive move, right? Higher, right? Everybody's like, that's it. They're potentially, looking for the Fed to slow down. They're not going to raise rates as aggressively. Maybe we go to a 1/4 point. I don't think really anybody who does any homework thought that was reality, but there was talks of that. It was a very unlikely scenario, I thought. As you know, Fed did 50 basis points. Market had a higher move, came back down, and so we had, after day one of the CPI, you have FOMC, so you kind of blend them together. And then you look at okay, FOMC yesterday, another thing where you looked at, you had this initial move lower, then you had a rally higher, and then a move back down. You saw that 3-point type move, right? And that's something that when we go to the charts, I'll explain a little bit more about it, but just visually, I want people to understand that. And now you actually take that back, and I think the opportunity always comes on day 3. So we kind of know that we set it up for a 3-point move when we're looking intraday. But when you get to the actual move of the market, where you think what you think the market truly digested these data points, I think always comes in day 3. And it does, because that simple thought process of day 1's the overreaction, day 2 is the reaction to day 1. And then day 3, we start to see if those reactions to the data points have confirmed technicals, if they coincided with them, or they contradicting them. And then you have a new trend in place. And then you have a period of time, I think, a sweet spot for some good trading. So I kind of threw a lot at everybody. I seem to do that at the beginning of these Develop Your Edge shows, and then I bring you back in. But I just wanted to kind of get that out there, and we'll bring some visuals to follow it.
Right. And I think, what you're saying basically is day 1 being the Fed day, the overreaction. Day 2 today is the reaction. Day 3 is almost like the dust has settled. There's really no more influence as big as there was on Wednesday. Let's pick a direction, or let's pick a dynamic, because it's 6 weeks away to the next February 1st, next meeting, 6 weeks away. Let's see where this goes. Yeah, we have some data points in between then now and then, of course, but it sounds like, hey, there's a little more guidance. Let's digest that guidance and let's go.
Yeah, the chase is over. Anybody who wanted to do something for that initial chase move is over. The squeeze has now ultimately happened for those that are wrong in whichever way they chased. In this particular instance, it's lower, right? So now anybody who tried to chase any sort of moves higher, thinking that we could hold a rally, they're basically getting squeezed out, right? And then you see how today ends. Then you come into tomorrow, which is it's hard to say that tomorrow really does determine day 3, because you have triple witching, you have full expiration now. So I think that really what we do probably coming into Monday, when you have another data point, or you have another something that's coming out like a triple witching. I'm not sure. Maybe it is quad witching. I think it's triple, but whatever. That is also something that is going to probably throw a little bit of a wrench in it, because you're going to have people. We talked about first day of the months and last day of the months on this show. That's when people have to do something. So anytime you have that, then your technicals kind of become secondary. But when we go to the charts here, I'm going to really kind of talk about what I think is setting up for the end of the year, because I think that since this is the last show of the year, I want to talk about what I see setting up for the end of the year now, based upon that 1 to 3 days following CPI and FOMC. So maybe we pull up the charts if we want. All right. So let's actually go to the daily here. First things first, right, everybody? I mean, I've talked about this trend line, right? This trend line for the year. It's kind of moved. I don't know if I moved it myself. But let me just move it back there, or what have you. There it goes. And this trend line has been super clean. And like I said, I'm not a trend line person, but how do you just deny this? I mean, we went up there and violated again, ran all the stops on CPI, comes back down, closes below the 200-day. Yesterday it goes up, it hits the 200-day and the downtrend and breaks again. It's like this market loves to find every stop possible. And it just always seems to get out. So it seems like they got a lot of people that were short out, and then potentially now you can start to see people starting to climb back in. So when you look at it from the perspective of CPI and FOMC, I look at them as kind of as one day. We went up and we tested and got through key resistance that everybody, I don't care who they are and what their strategy is, sees these two things and knows that they have now held. So now on a technical basis, on what I consider those 2 days as day one, you have a really strong confirmation that the downtrend is still in play. And a lot of people will say, well, draw a trend line to the upside. The uptrend is in play. From my time perspective, I look at it and say, this supersedes any sort of uptrend off the low. The uptrend off the low to me means nothing. So that's the first phase, right? So now you have day one, combine those 2 days into day one, you have a clear downtrend confirmation that it's continuing to hold. Today is day two, reacting to that, and you have lower lows than you've recently had. So now you have multiple confirmations the bear trend is intact. So we together on this one, Tom? That's the first thing I noticed.
Well, for sure, taking out those lows, getting below 4,000, I think is a big deal, right? That's a big psychological number. And then more importantly, that area of congestion that you see with the lows right around where we are now, we're below those lows. And, certainly if you were to draw an uptrend, you said you don't look at it, it's shorter trend. You're looking at the longer overall downtrend, but that's a break. That's a break of the uptrend that you see. So another reason to be bearish.
Yeah, exactly. And like I said, I don't like buying uptrends when the overall trend is down, right? So it's almost like I don't even want to see it broken, because in my mind, it's not going to hold anyway, right? I mean, yeah, it might hold a little bit. You kind of get to that point, but I think that's the primary trend to me is down. It's confirmed. And I think now, because this has happened, I know some people are going to think I'm probably a little crazy here for saying this, but I would not be surprised to see us come potentially all the way back down near the lows of the year. Now, I say this because when you have a key data point at a critical technical area and it cannot break it, that's why that day one is so important, especially around a critical area like this. I look at this and say, wow, this really tells me in a year where every rally has been sold, nothing's changed. You saw what happened with the ECBs this morning. The foot is on the pedal for rates to go higher. Don't see inflation going away anytime soon. What's really changed? A couple of decent CPI numbers that maybe I'm not a macro guy, but at the end of the day, the macro people I talk to are kind of like, well, it's just not more inflation than we've had, but we still have a lot of inflation. Okay. So now you have those things confirming that trend is still down. So, for me, I'm only looking at shorts between now and the end of the year. I'd be looking for, I think, potentially an aggressive sell-off here because of that. Now, we'll see what today into tomorrow brings, but I do think it's very possible on the big picture for us to see a steep sell-off into the year. And another thing I want to really put out there is that how many years, Tom, this is a good question for you. You've seen a lot of bull and bear markets. How many bull markets close on the highs of the year after some sort of pullback, October, November. They end up coming back and grinding up. Santa Claus rallies and bull markets are just a normal thing. How many bear markets have you seen close near the lows of the year, on the lows of the year? Many. And how many bear markets have you ever seen turn around at the end of the year with 2 weeks to go? Almost never. If the S&P is down 20% or whatever it is, or NASDAQ, how many times do they go, oh, they closed the year, they're only down 10%? It doesn't happen often. So those are more things I look at and say, don't look good.
Yeah. From a seasonality point of view, or looking back at multiple years, you certainly have that, that precedent of bull markets do this, bear markets do this. And in order for us to think that this bear market, we're out of the bear market, it's got to reverse quite a bit. It's not going to happen, I don't think, with 2 weeks left.
No. And, you got the roll coming off tomorrow, so we have expiration. We've got the FOMC and CPI behind us. We've seen them. The bulls took a punch in the gut, right? It felt like they had a chance. It's failed. Anybody who's sitting long, hoping for that seasonality rally or anything like that, doesn't look good. And the bears now, a lot of them that have been squeezed out potentially can come back in here, because now they have a good place to manage risk in the S&P, where you've got, maybe 60, 70 points of risk, which in the scheme of things is nothing, for a potential, I think, to come back down near the lows. Now, do we make a low? Do we go all the way to the lows? I don't know, but I do think, and the way I'll be playing the market is that I think it's very possible to come back into the high threes, potentially mid 3,000 areas in S&P. So now I actually want to take this to the intraday stuff, because I think it's pretty interesting to talk about this 3-point move as an intraday thing. And some of it is, talking about today, we talked about, how do you get an edge in trading these data points? And the reality is there are some tips, right? There is no edge, and there's no really clear tip, except that for me, when I talked about those 3 tips in terms of, there's nothing that I would say intraday is going to help you execute these better, because it's so unpredictable, and I always think that the best days for me is the day 3 and following. And so when you look at these 3-point moves, or you look what happens, you have a sell-off, you have a rally, and then you have a sell-off again, and then you basically have kind of what I talked about with that 3-point move. And when you look at it intraday, right, to me, what I look for from that day 1, as I talked about, is the overreaction. This coincides so much with what we saw in the reaction on the technicals that we had on the daily, where you have my opening 3-minute range. If you don't know what that is, I've talked about it extensively with Tom here on Develop Your Edge. It's the opening 3-minute bar with an anchored order flow VWAP. You need to order flow tools on Ninja to get it. I use it all the time. It's my favorite tool on the platform. And we had that sell-off. You came back down, and Tom, look towards the end of the day, how it turned into a bearish day, where you have the VWAP below the opening 3-minute bar. Market failed there. So I had that confirmation intraday to support a lower overnight session, right? So immediately I looked at it, and I was even talking with some of my friends in messages, just saying, it looks like the bulls are giving it everything they can, and they just can't hold it. And here we go today. And then you have a day where today comes in, and you open up, and this is maybe a little bit more in depth. And you look at what you see here. What I think is interesting for today is, remember, today is the reaction to yesterday, okay? Opening range is the high of the day. That order flow VWAP, look how fast it got below it. And boom, that's a downtrend day. Today's a day where I feel like you just keep looking to sell rallies off of the VWAP or the first standard deviation in this area, and you put your stops just above there. That's the way I would personally look to play it. Obviously, develop your own system. But that to me is the way I look at it, because it's a trend down day. So my strategy is confirmed on the daily. Day 2 is a reaction to day 1. All those failures today, I think, come to fruition. It's a day where I struggle to see any reason to be long. Anything can happen, but ultimately that's what I see. And the last thing I want to talk about is, we've talked about this order flow accumulation. Look at that today, Tom. You got more people buying offers since the overnight open than selling bids. This is the net delta. Okay, order flow cumulative delta. This, to me, what I love about seeing a higher number here, number one, it's rollover, so it could be tricky. But it just tells me that people are still looking for a rally. There's more people buying offers and selling bids. That could be a rollover thing. I don't know, but it just tells me that the squeezes just keep coming. Start to see this potentially unravel, and all of a sudden you have could have a decent sell-off today. So, that's really my overall look at it. I love layering the daily and that mindset of day one, what happened, day two, reaction to day one, day three, we see what happens. And that's kind of my outlook and how I'll be playing it.
Oh, that's great. And let's go over today real quick with the 3-minute opening range, with the VWAP, trading outside or ticking outside of the 3-minute opening range. You would basically sell into that when the price gets back up to VWAP. Is that what because your bias is short, right? You're bearish. You're looking to use that VWAP as a place where, look, if we tick back up here, we're gonna go short, and then you have a target on the downside of maybe second or third standard deviation of the VWAP, or is it a set amount that you're looking for, or how does that work?
Well, this is going to be, one R, right? So one risk to reward. If you sell the VWAP, you got to stop above the first standard deviation. So, but to me, this day is actually the one of my favorite setups for everything that I've seen, right? So you go back to everything I've talked about. Yesterday was a complete rejection of technicals. So same with the day before, couldn't close above the downtrend and the 200-day moving average. Now you have an opening range high with an order flow VWAP that immediately in 6 minutes into the day gets below the opening 3-minute bar, right? And you have buyers coming in. But what's interesting about this, and I should say this order flow cumulative delta, in a perfect world, I'd love to see them just hammering it to the short side. I don't mind seeing it a little bit bullish in terms of buying, because it could represent a squeeze. But this is all due to rollover. That is definitely a part of it, because you definitely see some influence from the spread, and the spread is between March and Dece. Okay, so just so people understand that. So order flow is important on these types of days. But you also have to understand that there's something when you're rolling contracts over. So you've got people selling Dece, buying March, right? So if you own December contract, you're selling, you're selling Dece and you're buying March. So you could have flows coming in to buy March that are selling Dece. So that order flow could be, a little bit misinterpreted. But to go back to what you said, is it's a day like today, we're on a technical basis. I feel that second and third standard deviations could easily be hit. Like, I'm looking for them to get hit today. Like, I think we will get second deviation at some point and third standard deviation with a 1 standard deviation risk. Now, I'm not in this trade right now, but that is the way I approach it.
Great. That's awesome. Good time to go to the question of the week from Twitter. How do you feel about that?
Yeah, let's do that.
Great. So if you want to participate, viewers, you certainly can. Go to Twitter and you can send a question using the hashtag AskDYE, stands for Ask Develop Your Edge, and put in the NinjaTrader handle as well, at NinjaTrader. And if we use your question on the show, we'll send you a nice little gift. Today, we've picked Alfredo Del Call, and I apologize if that's not how you pronounce your name. Why day trade futures? I think that's a great question. Basic,
well,
right?
Alfredo. Well, why day trade futures? Well, first of all, futures are truly a day trading product, right? I mean, a majority of the people that are not institutional, futures initially were created to hedge, commodities, right? And futures are a way for the big funds to hedge their risk. I mean, that's what futures are created for. But when you look at the little guys like us, futures are a way to trade a leveraged product because there's leverage there. And I think it's the best day trading products out there. There's so many advantages to day trading a future versus day trading a SPY or a QQQ. And just to name a couple, tax advantages. Talk to your accountant about these specifically. But when you're trading futures, you have the 60-40 rule. 60% is long-term capital gains, 40% short-term. I talked about the leverage. The leverage you can put in a smaller dollar amount and into an account, and you get immediate leverage. Versus going in and you have the pattern day trading rule when you have the SPY or the QQQ, right? And you don't have that here. Now, mind you, that leverage to me is also I think a very big negative in a lot of ways for new traders, because they're going to come in and they're not going to realize how fast and violent futures can be. And so that's why I like the micro products and other products, like even event contracts, which maybe I'll talk about those quickly in a second. But those are great products to come in and trade with less risk. And there's still, of course, there's risk attached to everything, but that is the reason why, for me as a professional trader, I day trade futures. I invest in stocks and I buy stocks and I do trade options and other things like that. And on the longer term stuff, I move to equities and things like that. But for day trading action, and to generate income on specific days, where I think the market intraday is where the edge is. And there's not always edges intraday, despite what some may say. You definitely look to the futures, I think, for an opportunity. And with all the new products out there, like I said, from micros to event contracts, there's a lot of easy pathway in that aren't as risky or as expensive, I should say, in there, because they're all pretty risky in their own ways. But that's what I'm looking at. That's why I think.
Awesome. Thanks for that, Anthony. I think you wanted also to mention something about product you're working on with the CME.
Well, yeah, this is a CME product. Maybe we'll pull this up here. If you go to cmegroup.com and go to event contracts, I just mentioned them. Event contracts are a great product, I think, for newer traders and also for traders that have been trading for a while, like myself. And an event contract is a daily option. Okay, they all pay out $20 or they pay out $0. So that's if you think that the market's going to close above or below a certain price. Like yesterday, actually, I bought a bunch of the 4,000 no's. I thought that the market can close below 4,000. It was a way for me to trade to the short side without having to be shorted outright in the future. But I bought the event contracts. It didn't work, but that's just something that I'm looking at. Like today, because I'm bearish, I haven't bought any yes or no's. Yeses are calls, no's are puts. A day like today, if I see it come back up to the VWAP and I think that we're going to potentially continue to go lower, I can go and buy some 3,900 or maybe 3,925s. I didn't see the strikes, buy the no's and think that the market could close below there. Now it has to close above or below if you buy a yes or a no. But I think it's also a great way for new traders to get involved, because it's a non-leveraged product, which is kind of what we talked about as an advantage. Even though this is a future and options on future, this is non-leveraged. So if you buy one for $5 or $10, it only costs you $5 or $10, and it expires at 0 or at 20. So you could buy one. I bought them at 75 cents and they've closed at 20. Doesn't happen often, but so you could make big percentages, but your risk is always tied to exactly what you pay for them. It's not like buying an E-mini and you have an unlimited stop, kind of, even if you don't get out, right? And you can just keep losing more than what's in your account. With this, that's not the case. So you just go to cmegroup.com and check out event contracts.
Awesome. Great. With that, we're going to wrap a little bit early. I want to say thank you to Anthony for coming, and have a great holiday season.
Yeah, I just want to say, everybody that's tuned in to Develop Your Edge this year, I absolutely enjoyed chatting with all of you. I loved it. Tom, you're great. It's always great chatting with you, and you and I bouncing ideas off of each other and trying to help these traders develop an edge. We know how difficult this business is. And one of the things I want to say to everybody before I get off the mic, this is my last video of the year as well. Everyone knows I do a lot of other stuff. And I've said this really the past several years to all the traders. This holiday season, give yourself the gift of time. This business is not the easiest. It took me years to start eventually turning the corner and make some money. I know a lot of you are newer traders out there. Give yourself the gift of time. If you try to make money right away in this business, or if you put that pressure on yourself during the holiday seasons, it's tough. Enjoy the holiday seasons. Don't ruin Christmas. I've ruined many of them because of trading, doing dumb things. Don't do it. Give yourself the gift of time. And I want to wish all of you guys a Merry Christmas and a very happy and prosperous New Year. And thank you and a shout out once again to everybody at NinjaTrader. This crew is amazing, and I really love this show, and I love everybody at NinjaTrader. So thank you guys. I love being a part of this.
Well, Anthony, we feel the same about you, and it's been great. I know you have to run, but we'll see you next year. To all the viewers here, thank you for coming and watching the wisdom that Anthony has to impart. But we will be back, Jim Cagnina, this afternoon. Actually, no, that's not correct. I'll be hosting Bars Closing today. But Anthony, again, thanks as always, and we'll see you in the new year.
See you, everybody.
Thanks.